Most funds now are 15 years old. The value creation plan by the private equity managers is really executed in the first few years, investing in the company, driving organic growth, doing M&A activity. So theoretically, in a fund where you've got a 4-year investment period, the next 4 or 5 years is where all the value is created. Assets are sold then, so whatever is remaining tends to either have reached its value maximization for whatever reason, the market timing, the asset can't be sold, or those companies may not be living up to expectations from a return standpoint.
Hello and welcome to Liquid Courage. I'm David Snow, your host, and today we're joined by Ryan Binette, a managing director and co-head of Secondary Capital Advisory at Piper Sandler, Tom Kerr, managing director and head of Secondaries and co-head of investments at Hamilton Lane, and Joncarlo Mark, founder of Upwelling Capital. Gentlemen, welcome to Liquid Courage. Thanks for being here.
Thanks for having us.
So we've got a great topic today from a proprietary research report that the good folks at Upwelling Capital put out. It's got a great title, No Country for Old Funds. Joncarlo, did you come up with that title? That's good.
That was a team effort, and we're all kind of movie buffs here, so yes.
Excellent. Well,
as a group.
Well, if you're impressed by the title, you'll be even more impressed by the findings. Basically, I'll just ruin the whole plot here and say that the findings are that if you are an investor in the private equity industry, you should probably sell the stakes in your funds once they reach a certain age. And we're going to explore when, where, and why. Why don't we just start at 1,000-foot level? Ryan Binette from Piper Sandler, do you mind just setting the stage for us? Is there an issue out there with limited partners having ownership of these interests for longer than was anticipated?
Yeah, I don't think anybody initially thought that these particular funds would go out 15 to 20 years. It's definitely a concern for certain investors. There's been a general lack of liquidity across the board, across a number of these, vehicles that have taken a little bit longer to liquidate any of these investments that they may have had, which is resulting in these funds going out well beyond what they initially thought. So there's definitely more of a financial obligation to kind of help reduce those interests, especially for these larger vehicles that have been out there for too long.
What is the oldest fund that any of you have seen for sale? You don't have to name names, obviously.
There's definitely funds that are back into the 90s that are still going. I've been doing this for a long time, and there was a fund that Hamilton Lane invested in 1996 that liquidated in 2022. That one, from my perspective, was the longest one out there. I think there are still 99 and 2000 vintage year funds that are floating out there.
There's plenty of funds that are 20 plus years old that still exist in the market.
It's nice to say, though, that you're looking at a fund from last century.
It's from the 1900s.
Tom Kerr, from your perspective at Hamilton Lane, why is it a challenge for investors in private capital to decide what to do once their participation in a fund reaches a certain life stage?
The challenge is that the longer you go out, the less upside potential there is in the fund. And when that dynamic exists, the price that you're going to receive back for divesting is more heavily discounted. And so as the discount grows optically, nobody really wants to sell at a 30 or a 40% discount. But as a buyer, to say I'm taking on something that might actually be worth less than what it's marked at today over time because these assets are harder to sell, that's where I'm going to be willing to buy it. And the fact is there's many, many more of these funds and much, much more of this exposure than anyone has capital to put against from a buy perspective. So you have the benefit of, as a buyer, to say, I'm going to be selective around where I can get that exposure if I'm interested in that tail end strategy. And as you said at the beginning, the longer you hold on to this, the harder it is to sell at a price closer to the NAV. And so even if you've made a good return on that fund, over the history of it, the idea that you're taking that sort of haircut at the end is hard to digest.
Well, why don't we jump right into the first finding of the Upwelling report? Private equity fund values tend to max out at 9 years and then begin to decline. Joncarlo, why is this an important finding, and what does it suggest about what people do when they have older funds?
The reason why these funds are getting older is because the average hold period has increased 50% in the last 15 years. So according to research provided by Bain, that hold period has gone from 4 years to 6 years. So therefore, a 10-year term is very rare to find a fund that's around only 10 years. Most funds now are 15 years old. The value creation plan by the private equity managers is really executed in the first few years, investing in the company, driving organic growth, doing M&A activity. So theoretically, in a fund where you've got a 4-year investment period, the next 4 or 5 years is where all the value is created. Assets are sold then, so whatever is remaining tends to either have reached its value maximization for whatever reason, the market timing, the asset can't be sold, or those companies may not be living up to expectations from a return standpoint.
I thought private equity was a long-term asset class. If you're in year 9, it seems counterintuitive to think that you should probably get out.
I would say that the higher quality assets that have real options for liquidity are sold earlier in the life of a vehicle, when other assets that are harder to sell or maybe underperforming really pushes out exits beyond that 9-10 years. The GPs, obviously trying to maximize that value, but just it's taking to be a little bit longer for them to materialize that.
Yeah, I'd just add that I think the structural limitations of what the general partners can do with those companies in year 9 of a fund is the underlying issue. At that point in time, you're not really permitted to call capital for follow-ons or execute new initiatives in those companies to drive the value. It's sort of in a runoff mode. Not to change the topic, but that's why we've seen an increase in continuation vehicles and GP-led solutions, because when you get to that point, there's not much you can do under the current structure. And that's led to some real deterioration of value in certain cases because those assets almost become a bit, not orphaned, but unable to be optimized.
And there may be another element to that, which is the misalignment that may evolve over time, particularly when you consider the hurdle. The managers won't get paid unless they're above that 8%. And that can create problems where the manager is incentivized to hold assets longer with the hope that those assets actually increase in value so they get that clearance of 8%. Or the clawback has been created, pushing out the fund life delays oftentimes their requirement to make whole on profits and carried interest they had taken earlier in the fund when they were above that hurdle rate, where they're now subsequently below the hurdle rate.
Well, interesting that so much value creation tends to happen early in the life of the fund, and you can sort of tell maybe where the fund performance is going to go earlier than at least I would have expected. That takes us to finding number 2, which is the weaker the performance, the earlier the valuation peak. Joncarlo, walk us through this because it suggests that if a fund is destined for 4th quartile status, you're going to want to sell your interest in that fund even earlier. Is that correct?
The analysis is based on almost 1,200 funds. And what we found was 4th quartile funds and lower actually have earlier peak TVPI to investors. One option for investors is to sell those positions earlier to try to maximize the value, because once they peak at year 6, you have a long, steady decline in value, which when you think about the opportunity cost is pretty taxing to investors. The other option is to engage with the managers and talk about what they can do, and perhaps with the writing on the wall that their ability to clear a hurdle rate is unlikely, what other incentives can be put in place? Should there be a restructuring? Should there be even a move to consider other options as it relates to replacing the management of that fund in the worst performing situations?
Ryan Binette from Piper Sandler, in your experience, is it the case that a underperforming fund sort of reveals itself fairly early in the process? And that must be somewhat of a painful thing to admit if you're an investor that maybe you should just bail on one of these underperforming funds. How do you see that play out as you're advising investors?
Yes, as you're talking to investors, I would say they initially go to market with the funds that are underperforming sooner because they can see that there is some challenge within the portfolio or the particular manager. I would say the buyer community, as you can imagine, don't necessarily love that. So there's always a give and take and adding additional funds that may be a little bit more creative to the value and creating a portfolio that will meet the needs or expectations of our client or their board. Our job is to create a portfolio that is going to make the buyers happy, but also get the sellers a price that they're willing to transact at.
Tom Kerr at Hamilton Lane, what is your experience? I mean, it seems kind of heartbreaking that you would learn so soon in the life of a long-term fund that it's probably not going to go very far.
Overlaying pricing from Piper Sandler with the analysis of the funds that are reaching their peak in year 5 or 6 as trending to fourth quartile, I'd probably suggest that your pricing on those is not all that attractive. And you have the same dynamic of, well, I don't want to sell this at 70 cents in year 10. I certainly don't want to sell it at 70 cents in year 5. And so that's where the buyer community also understands what's going on in those funds, often better than the limited partners in terms of understanding the go forward. There's not a lot of appetite for something that is trending negatively at that stage. And if so, it's going to be at a bit of a discount. Not everything follows the same pattern. You can find those funds that redeem themselves. You have to be careful of throwing the baby out with the bathwater. But overall, I think being on top of your portfolio, understanding what's going on with it is critical.
I'd like to go to the next finding, which is an interesting scenario that you could set up where you compare two different investors who follow two different policies. Investor A sells a fourth quartile fund at a 40% discount and then takes the proceeds of that sale and invests in a fund that ultimately becomes a median performer. If in year 10, when the sale takes place, the investor gets $60, by year 16, that $60 invested in a median performing fund is now valued at 97. Then let's look at investor B, who has a lot more hope for the future. They hold on to this fourth quartile performing fund at $100. And then lo and behold, by year 16, that's worth only $87, which is $10 less than what investor A got for just cutting bait in year 10. Joncarlo, help us understand that story a little bit better.
The key for the investors is to understand that you have to think about the opportunity cost of not selling positions as opposed to what is the discount that I'm going to take and just being worried about the optics of that point. Historically, investors have been generally quite weary of taking significant discounts. And the idea of taking a 40% discount in a fund oftentimes is something that's difficult for them from an optic standpoint. But when you consider the opportunity cost, it's clear that even taking a 60% discount and putting that back to work in something at just a median, if you could get in a top quartile, the outcome is even better.
Ryan, what's your view on the opportunity costs? What are you hearing investors out there say when confronted with needing to take a haircut on whatever fund they're invested in? Do they sometimes need a bit of coaching that, hey, you can reinvest this money and it might do a lot better than if you just hold on and hope for the best from this fund that you're in?
There's a lot of positive things about the secondary market, I would say, and we've all been kind of lucky to be a part of it. But one of the key reasons why people sells because they are rebalancing their portfolio and reallocating to managers that they deem as core to their future returns. So there is obviously a little bit of heartburn when somebody has to take a slightly bigger discount. I think it really depends on the particular manager or the industry or if they're sector focused or not and their belief on how that sector may perform going forward. But if you can redeploy that capital into a manager that is top quartile, there's obviously a massive opportunity cost to do that. You just have to balance the discount with what the future return looks like, and then how long will it mitigate that J curve to get into positive territory.
But David, it's not just the cost. There's administrative expenses as well. So one can just think about it in the discount. For every fund that's active, if you're a fund of funds, for instance, you've got to spend time monitoring that, reporting on it. It extends your hold period, so you have to do audits on your vehicles. There's a lot more that goes into, a lot more costs that an investor has to incur by holding tail end funds when they are better off not only just selling and recycling the capital, but also alleviating the administrative costs of maintaining oversight on that portfolio.
Yeah, I'll just add, I agree. A lot of our clients, particularly on the fund of funds or secondary funds, when they're winding down a portfolio, has a lot to do with the K1s and costs associated to a vehicle. They're always price sensitive, but there's a point that they become a slightly less price sensitive. But if you run a very competitive process and you can showcase that you got the best price in a competitive process, you feel a little more comfortable in accepting maybe a slightly higher discount.
Yeah, I think the irony there is that the secondary funds themselves are amongst the biggest sellers of secondaries because they understand how it works. And they understand that we bought this at a point in time, we made a return, and we've now got to wrap that up and let someone else take it the rest of that journey. When you're at this tail end level, the percentage of the net asset value relative to the overall return of the fund is often de minimis. And so the discount needs to be taken into context. There are other factors in administration and other things, and just the overall time value of money of saying $1 today versus $1.50 tomorrow. There's a trade-off in that decision.
Well, this takes us to the next finding, which will alleviate some anxiety around getting the timing of the sale exactly right. I would imagine that a lot of investors are conscious that as time goes by, especially in an underperforming fund, they're starting to run out the clock on being able to redeploy that capital in something more meaningful. And yet, one of the findings from the Upwelling report is that LPs have a selling window during which they can sell a fund interest and achieve relatively similar long-term results. So I guess this is good news, right, Joncarlo, for investors who maybe they think they should have sold a couple of years ago, but if they're still within that window, then the variance in the outcome is de minimis.
If you look at it in a total portfolio, you tend not to see value falling off the cliff overnight. You tend to see this sort of slow, steady flattening of performance. And then it's just a story of illiquidity or when those assets will ultimately be exited. However, it does show that LPs have some time. They don't have to make a rash decision. But nonetheless, if you have a portfolio that is not generating returns and you managing a private equity program where your objective under your investment policy is to generate a public markets return plus a premium, even flat returns is unacceptable.
We're seeing groups now be very opportunistic in the secondary market where, historically it was selling a large portfolio and you would group a lot of assets together. We're seeing groups now saying, hey, listen, we have a fundamentally different view of this particular industry or sector, and we will utilize the secondary market. And the beauty of a secondary market or any market is you can find somebody with a different perspective than you may have. So,
David, one thing I'd add to that is as you see a turnover of investors in a fund, and all of a sudden you'll see funds where over half the investor base is turned over and you have several secondary funds engaged, it's really an opportunity to motivate the managers to wind down a portfolio in a reasonable period of time. If it's year 10, maybe giving them 2 years. There has to be a recognition at a certain point in time that additional upside may not be achieved. So then it's just really about a timing of getting out of those assets.
Let's move to the next finding, which is you should probably sell before the value of your distributions equals the total value of your investment. Joncarlo, what do you think is significant about that moment in time in a fund's life?
Well, you've got to leave something on the table for the buyer. So I turn it over to Tom, really.
Yeah, look, when you're left with the very, very end of the portfolio, you're left with asset analysis, but you're also left with analysis around liabilities and what you're stepping into and how the fund's going to be wound down and when does that cash come back and what holdbacks and other things that may exist that are often de minimis when you have more substantial NAV. Well, you're left with the very, very end that becomes almost worthless for a buyer. It's option value.
we've seen in a lot of portfolios where the assets are just stranded. There's no real liquidity path, or they raised in the growth space raised a massive round and that valuation is likely to come down in the next round. And so I agree with what Tom says, as these funds get longer in the tooth, it's harder just to predict future value.
And Ryan, have you seen situations where it's harder to attract sellers because sort of all the juice has been squeezed out of a portfolio and that's what makes it difficult to sell?
Well, it always comes down to price. We're pretty upfront and honest with folks and just kind of tell them where we think the market's going to price something. and then just give them rationale for why we think it's got a price there. I would say it's harder to find the buyers sometimes because they're seeing that, and the discount associated to them buying that is so great that it turns off our investors. So it's really balancing to finding a price that our sellers are willing to take, but also finding a portfolio we think is going to garner enough attention from the buyer community.
David, my experience is that there's a buyer everywhere in the market. It is a conversation around price. Oftentimes, secondary funds are reluctant to put forth a price if the discount is more than 50% because they deem the seller is just not willing to take that price. However, based on our analysis and the work that we and people like Ryan and Sandler does to develop the story here, if investors understand that the opportunity cost is great at the tail end, there's not a lot of NAV left necessarily for them, that they're willing to take a substantial and reasonable discount given the term and the life of that fund, I think you may see even more activity in these tail end positions, albeit at pretty steep discounts. LPs can be more open to bigger discounts in their funds that are 13, 14, 15 years old.
There's a fair amount of groups that do buy almost not entirely, but very much specialize in doing tail end portfolios and creating a process that you can showcase to your client that you maximize value. And you hope that in the process, we find an outlier bid that makes our client feel comfortable that they're selling at a market clearing price.
Tom, is it your experience that if prices get below 50%, that parties tend to scatter?
From the buyer perspective, we have finite time and resource to spend on these transactions. You have to understand where someone is willing to transact. And I think if you're getting down to those steep discount levels, the job's harder for Ryan to find a group of buyers. We're not going to be as willing to compete with 4 or 5 other buyers for something that has that kind of characteristic to it. We almost have a handshake of, if we can get to this price, then you're going to be willing to transact, and then we're going to go do the heavy lifting to understand if we can deliver on that price. So I think the universe gets smaller. I agree with Joncarlo. There's buyers out there for everything, but if I don't know that there's a path to a transaction, I'm going to be less likely to dedicate resource against something of that nature.
How much of a factor is the very human tendency to hope for the best? Maybe it's a first-time GP, or at least a GP who just has fallen in love with the portfolio companies, who says, you know what, guys, this is going to be so much better in the future. What kind of conversations are you having with GPs who perhaps are more hopeful than the evidence warrants?
Well, I would say GPs are generally optimistic by nature. The situations around some of what we're talking about with tail end, is it a manager that has raised subsequent funds? And if they've not raised subsequent funds, then I think the idea that they may be holding on to something too long because it's perhaps their last hurrah, there's a little more skepticism around it.
Is there a way to determine if there might be a late bloomer in the portfolio? How often do you come across a situation that goes against some of these findings?
If you look at the entirety of sort of the 2006 and 2007 vintages, that was the story. There were many companies that were over-levered at the very beginning, that were good assets, that were able to muddle their way through. And then when you look at the end of the day returns on some of those funds, they generated 2 times money multiples or plus or minus 2 times money multiples. And at some point in time in 2010 or 2011, they might have been marked at 50 cents. And so buying those funds at that point in time, 5 years in, when they looked like they were really performing poorly, you buy at 0.5 and you pay NAV, it goes to 2x, you make it 4 times your money. We have had less cyclicality in private market generally for the last, call it 15 years, but just early write-downs can portend towards perhaps redemption stories and sort of to a pretty good outcome on the secondary side.
And David, there's another element to that, which is a secondary buyer obviously is doing their underwriting to determine which companies actually have upside, but also they can bring fresh capital to the table. And there may be opportunities where there's a late add-on. The fund may not have the original fund may not have the dry powder. The new investor can come in, or an existing investor, to put up additional capital for a co-investment to allow for that add-on transaction. So these are some of the things that secondary funds have the opportunity to consider that could help drive those late bloomer assets in a fund.
How early are the three of you seeing investors initiate a sale process? Year 2, year 3? I mean, is it possible to detect underperformance that early? And what's that conversation like?
The earlier the fund, it's more challenging because there's a lot more unfunded, and there's points and times where unfunded is looked at more favorably if it's a good investing period. But not to speak for the buyers, I think they want to see at least 60-70% that's invested so they can do their diligence and kind of see what that path is in the next 5 to 8 years. For liquidity, we see groups sell for very, very different reasons, mostly rebalancing of portfolios, but some groups are more concentrated on co-investments, and they're not seeing co-investments from the particular manager and will look to liquidate. Doesn't mean it's a bad manager, just means that they're not seeing some of the aspects of their investment that they were hoping going in.
Over the last 5-7 years, you have seen more opportunistic selling of rebalancing portfolio around strategy. A lot of people over invested in venture and growth in the early 2020s. And so you're seeing some of those portfolios come to market, which may include some of the older stuff, but may include some of the newer stuff too, because they're just looking at overall exposure to the asset class, which has had challenges on liquidity, and saying, hey, we might as well sell some of the new stuff as well. So we've seen portfolios with positions that maybe haven't drawn any capital or just right out of the gates. In addition, you have managers that are now more active about managing their LPs. And so you have an LP, they're invested in fund 2, they're invested in fund 3, you're coming back for fund 4, and they say, hey, you know what? We're not going to invest. And the GP says, well, if you're not going to invest in my fund 4, would you consider selling my fund 2 and my fund 3 to someone that is going to come into my fund 4? And so therefore you're looking at that as maybe a 2 or 3 year old fund that is just getting out of its investment period as the GP is raising that capital, and they're trying to facilitate a secondary trade to find a new investor to take the place of that LP. That's a recent new development in the market. You would have never heard of that 10, 15 years ago, something that's sort of come on as the secondary market has really grown.
There are always investors who need liquidity or have overcommitted to the asset class and need to reduce their outstanding unfunded. As this industry goes more and more to the retail side of things, you may see individual high net worths fall into that category for whatever reason: estate planning, divorce, those kind of matters. It may be small, but they need liquidity. They need to reduce their exposure to the unfunded. So I do think this is going to be a part of the market that will continue to grow, but it's always been there. Seasoned primaries, they've always been there. You may see more of that happening.
We find that GPs are utilizing the secondary market to times pretty regularly. They see that there's benefits. It's not always around a CV. It might be around the individual investor, but there's a lot of tools for GPs to use the secondary market today, and it's just ever evolving in today's market.
What makes you excited about being part of the secondaries market going forward?
I believe the tailwinds for private markets are very strong. I think you're going to see continued investment and continued flow into private markets. And the only way that that is sustainable is for the secondary market to continue to provide liquidity options. And the creativity and the variety of those liquidity options continues to grow. It's a super exciting space. I think we're sort of at the tip of the iceberg. This will continue to grow. That's what really makes it exciting for me. Having been doing this for over 25 years, it's never been a more interesting time.
I think the creativity of this market is exceptional. I'm always impressed with new creative solutions that are being brought to the market. We would like to think we're at the forefront of instituting a lot of those with the sheer amount of capital. And then you theoretically will have 401ks coming into the private market. I just don't see how this market doesn't continue just to grow and go up and to the right. We're starting to see a lot more credit secondaries, infrastructure, just sheer amount of capital being raised in the buyout space. It's a very exciting place to be. And as I said before, I'm lucky that I've been a part of it.
If you go back 25 years ago, it was such a nascent market that the secondary market was basically reserved for financial institutions. Recall the banks, due to new regulation, were required to sell assets, or a handful of big institutions that got involved. You fast forward to today, it's such a robust market, but it also follows the overall evolution of the private markets. Whereas pension plans in 2000 had about a 3% allocation to private equity. Today, that's in the mid-teens. Obviously, some institutions are well into the 20 and 30% exposure to just private equity. Their private markets are a majority of their overall portfolio. With the access to information and the liquidity that's provided and the creativity that's provided in the secondary market from an LP standpoint, they can take a much more proactive role in portfolio management by utilizing the secondary market.
Well, Ryan Binette from Piper Sandler, Tom Kerr from Hamilton Lane, and Joncarlo Mark from Upwelling Capital. Thank you all so much for joining a Liquid Courage program, and I hope that we can have you back in the near future.
Thank
Thank you.